Reporting season gives a portfolio manager a chance to review current holdings and a chance to survey potentials. Simon Conn is a portfolio manager at Investors Mutual, and he's always on the lookout for good value companies. So let's just see what he's found in recent times. Simon, thanks for joining us.
Thanks, Peter. Thanks very much.
Now, reporting season, mate, I know you're not a person who's renowned for your public example illustrations of your excitement, but do you get quietly excited around reporting season?
Oh, it's a long, drawn-out process, Peter. So it gets pretty tiring towards the end. But look, it's a good period and a good time to catch up with most of Australia's corporates and get a snapshot of how they've been travelling and what they think about the next 12 months.
When you're analysing companies, and I know after talking to you over a number of years, you like to have a strong belief in the company, the fundamentals of the company, but do you ignore the whole macro setting and the, in a sense, like to quote the movie The Castle, the vibe? You know, the vibe from reporting season was, well, earnings are getting better, driven by resources, but not quite as good as we thought. Is that something that enters into your equation when you're looking at individual companies?
Look, I think for a particular bunch of stocks, you've got to be cognizant of where they are in the cycle, Peter. But generally, you try and back a good management team and try to own it through the cycle and own a business that can do well through the cycle and continue to grow its earnings. But for particularly cyclical stocks, you've got to be very cognizant of where you are, and maybe in the building materials or the retail cycle or in the mining cycle, as you mentioned.
Yeah, well, a lot of my viewers, buy cyclical stocks. Do you think that, and there's a lot of economic data has come through in recent times. Simon, do you think the Aussie economy is gradually stepping up to a higher level of growth, which we'll probably see more conclusively in 2018?
Peter, I think our conclusion from reporting season and talking to most Australian companies is that we're in an environment which hasn't changed for the last 5 to 6 years. It's a grind, and for periods of time you'll get a little bit of pockets of growth, and things feel like they're picking up. And then you have periods of, like I think we saw around April, May earlier this year, where things are pretty tough, and the economy feels like it's pretty limpish. But if you look across, the market and what it's been doing, I think that sort of mirrors the economy. It's a tough, slow growth environment, and the consumer's being crimped by higher utility costs, higher costs of living, higher mortgage debt, mortgage costs. And so, for most companies, it's tough work growing their earnings.
Okay, let's talk about some of the companies that have come onto your radar screen, as I said in my intro. So let's go for it.
Yeah, well, one stock we saw during reporting season we've owned for a while and talked about on your show in the past, a company called Ansell, is a leader in its sphere. It's a leader of. It's a leader in its sphere. It's one of the about 20% market share globally in hand protection. So it's a leader in industrial hand protection and also medical hand protection. They recently sold their sexual wellness business, or their condom division, for $600 million to a consortium including a Chinese investor, recognised a price of about 16 times EBITDA. That's left the company as debt-free currently. They're doing a buyback of about $250 million. And the second half sort of displayed some of the niche things we've been looking out for some time, and they started to deliver some organic growth, particularly in their industrial hand division. They've been investing for several years in new products. Those products are now seeing them getting increased traction in the market. They've signed exclusive distribution arrangements with companies like Grainger in the US, and that's delivering good organic growth in their portfolio. The medical division was a bit softer. They had some manufacturing issues earlier in the year, but the second half showed signs that that's improving as well.
Because they sold their condom business, and a lot of people thought, well, what are they going to sell? Well, and they've been big on gloves, but people said, well, everyone's doing gloves. What is the actual situation of the company? Where are they making their money now?
Well, I think, Peter, it's a bit like the old bold ad about oils ain't oils and gloves ain't gloves. And I think the thing that Ansell have done really well is focusing on something which is perceived to be quite a boring product category, and continue to innovate and bring new products to development. So they've got a range of industrial hand protection products, which suit different various applications, whether you're in manufacturer or a firefighter or you're in the army. There's a range of products. And then similarly in the medical space, they've got a range of products that protect people's hands through surgery or in the physician's life, and different applications for different people in different points of time.
Okay, let's go to your next company.
So Shopping Centres Australia, it's a stock we've owned for quite a few years now, since it was spun off by Woolworths about 4 years ago. But a really solid management team, and a business that continues to eke out operating profit growth, free cash flow growth, pays you a good yield, around 6% at the current prices. And a company, a management team that are very focused, internally managed by Anthony Mellows and the team. I'm very focused in terms of improving the portfolio and growing their earnings through time. They've moved their portfolio out of New Zealand. They've spun off and sold a few of the non-core portfolio assets, and they've continued to acquire and improve the quality of their business.
Now, I'm sure some of my viewers will be thinking, hang on, shopping centres, and there's a thing called Amazon coming that's going to, consume the entire world. Obviously, Simon, you don't think these shopping centres are going to be consumed and destroyed by the monster called Amazon?
Well, the good thing about shopping centres in Australia, and the reason we like this particular stock, is it's a neighbourhood shopping centre portfolio. So it's very focused on, in being in your neighbourhood. The convenience retail sector, it is a focus. So we're not into high-end fashion. It's daily needs-based shopping. 50% of the portfolio is leased to Coles and Woolworths. So it's, and I think the thing about the internet we're learning through time is that the last mile is very difficult, particularly for smaller value items such as groceries, where it's very hard to get that range of product to the consumer in an efficient space.
Okay.
Particularly in a country as diverse as Australia, Peter.
Okay, mate. And finally, you got another one for us?
Yeah, look, one other stock we've been owned for some time, which we just recently has got a new management team, is a company called Integral Diagnostics, and we like this business. It's it's a tier 2 radiology business in terms of size, but it's very focused on the regional areas of Australia where the population is a bit older. So obviously there's a greater opportunity set for them in that area. And the reason we like radiology is that because it really comes together in terms of healthcare and technology, two growing themes. And what doctors are able to do now with radiology devices is, a greater level of, as opposed to surgery in the past for exploratory reasons, they can now do scans and find out much more about what's wrong with your body or what ails you, so that the ultimate treatment can be much more targeted. So really, there's a range of tests they can do now that didn't exist 10 years ago. So the range of, and I think as time goes on, you'll see more and more tests and more about things being able to diagnose.
Yeah, so I would suspect in many regional areas they're like little monopolies that they don't actually even have any rivals in the town or the city.
Well, in fact, Integral actually received, and I think that was one of the things that was soft in the first half. 2 new competitors started up, but going forward now, I think they've cycled that. But I think importantly for the new management team, led by Ian Caddish, he's got a strong background in healthcare, that he's actually calling out the opportunity for them to get some operating leverage and to actually operate their business more efficiently, take some costs out, and get some top-line growth and some margin expansion into the business. All
right, Simon, as always, great to see you, and thanks for sharing those interesting companies with us.
Thanks, Peter. Thanks for your time.
Simon Conn from Investors Mutual. After the break, we'll bring you part 2 of that interview with legendary fund manager and CEO of Magellan Financial Group, Hamish Douglass.